Hey guys, how's it going? Welcome back to another explanation of chapters from IB Business Management. Today, our chapter is going to be chapter 3.6, efficiency ratio analyses. They are plural analysis. Anyway, this is an HL only chapter, so high level only. If you're in standard level, you can skip this one. And we'll be back shortly with chapter 3.7. And that'll be again, standard level content. But this is important to know for high level learners, so pay attention. All right, so efficiency ratio analysis are not very difficult, but they are important, as I've said. Basically, what these do is they look at how well a firm's financial resources are being used. All right, this is looking at the efficiency of money use, cash flows, and that kind of thing. And each one works a little bit differently. They have different purposes, but they all have that general goal in mind. All right. So the first type of efficiency ratio analysis is inventory and stockholder. All right. So what you look at with this is the number of items a firm sells, the number of times a firm sells its stock within a time period. When we're talking about this, we're talking about sales volume. All right. So this can be calculated using one of two formulas. One is that it's equal to the cost of goods sold divided by the average stock. So the cost that you're spending to create your goods divided by the average number of goods you have, or the average stock times 365, because that's the number of days in a year, divided by the cost of goods sold. Either of these formulas is going to get you basically what is the speed at which we are constantly selling and replenishing our stock. Because cost of goods sold indicates how much money we're spending. So that indicates the quantity that we're producing, that we're creating. And the average stock is how many we have right now, is the amount of units. All right. So this is basically looking at what are we spending on creating these? How many do we have in stock? How many are we selling? All right. And anyway, so all this information allows for us to see how is a business moving its products. And what you want to avoid in this situation is that you have a lot of stagnant products, a lot of products you're creating and not selling, or that your stock is being replenished very slowly because you don't need to replenish it. In this case, the higher the ratio, the better. That's to say, if your cost of goods sold is high related to your average stock, or if your average stock per year is high related to your cost of goods sold, that's a good thing. That means that you're selling more of your products, you're having to replenish your stock more often, and you have more profits. All right. And again, these are calculated two ways. I think the simplest way is the stock turnover is equal to cost of goods sold divided by average stock. That's the simpler formula. All right. So what we're seeing there is if the cost of goods sold is higher relative to the average stock, what that's telling us is that we're spending a lot of money, and the average stock that we have on hand is pretty small, which means a lot of that money is going into stock that's being sold. There's not a lot of stock we're holding on to. High turnover. So again, if the ratio is high, that means high stock turnover, high inventory turnover. That means we're selling a lot. High turnover also means that perishable stocks don't expire and durable stocks don't become outdated. This is a good thing because, again, we want to avoid that we're sitting on stocks of items. We want to make sure that we're selling all of those items. So that's what this is also going to show for us. Again, the formulas are a bit odd in terms of how they get there, but they're a bit indirect. But they do both tell us, again, what's the speed at which we're using and selling our stocks. All right, the next one is debtor days. Okay, debtor days. So debtors, we need to remember, debtors are people that owe a business money. All right. And specifically, so debtor days tells us the debt collection period. All right. The amount of time that a business needs to collect money from its debtors, or that it's spending on average to collect money from its debtors. And this one also is a bit complicated. It uses some averages, but I'm going to explain everything step by step so that it's understandable. All right. So if this debtor days is very high, that means that you're taking a very long time to collect debts back from the people that you're getting money from. That means that you might have not very much money because you're waiting a lot on, money that you've sent out, money that you've given in debt to be paid back to you. If it's very low, the problem is customers may decide to just not become debtors of the company, because if you have such a low amount, that means that you're going to be very demanding in when they need to pay back their debts. They might go to a different company that gives them more time to pay back their debts. So the way you calculate debtors is this. You have debtors divided by sales revenue by 365. This will give you the number of days. All right. To get an example, in ABC Corporation, this is an example I used in a previous video, but I think it's good here. So we have the debtors, all right, the amount of money, because we're talking money here. So the amount of money that ABC Corporation has from debtors is $800,000. The amount of sales revenue they have is $3 million. So if you multiply that, so if you divide those two and multiply it by 365, that gives you 97.3 days. So on average, when someone becomes indebted to them, they pay back within 97.3 days. Now, how do we know this? You might be asking, well, how are these things related and what does this have to do with time? Because these two numbers appear to have nothing to do with time. They're just two financial figures. Well, that's because we're talking about average, all right? Because what this tells us is it gives us the proportion of the revenue of the money that a company has that is tied up in outstanding debts. Because remember, all the money that comes into the company are coming from our revenue, but our other cash inflows. And so then we're giving some of that money out. This $800,000 isn't money we have. It's money we're waiting to come in. So it counts as an asset. That's one thing. If you saw the balance sheet video, debtors count as assets, but this is money that's outstanding, that's out there with another business. It's not money that we have. So this is the proportion of our money that is tied up during a certain period of time. In this example I gave, that's during a year. But obviously you're going to multiply by a different number. If we're talking within a month, well, then you multiply by 30 because it's 30 days. All right. So we're talking days within whatever the period is. If it's 2 years, well, then I'm bad at math, but 800 days more or less. Anyway, so what we're doing here is we're then assuming, so this is the proportion, all right? So we have the proportion of what percentage of our money is tied up in debts, and then we're just assuming an average, that the percentage of time the percentage that debt is of our overall money that is being tied up in these debts, that's the percentage of our time in the year that we're going to spend getting that money back. So that means 800,000 of 3 million is like relatively a third. So then we're going to spend relatively a third of the days of the year, which comes out to 97.3 days. We're going to spend that time getting back that money. We're going to give that amount of time for debtors to pay us back. All right. So that's basically, it's about a third of our money. So we take about a third of the time in collecting that outstanding debt on average. All right. So this is all working with averages here, because there's not really a way otherwise to collect or to calculate this. But this is the way that you calculate it, is using these averages. That in theory, if it's working this way, that's how it should go. All right. Then the next thing we have are creditor days. All right. This is the next ratio. So this is the credit payment period. Think about it this way, that we had in also one of the previous videos, creditors count as a liability for business, because credit means that we have bought a certain good on credit. All right, we've bought whatever the case may be. Usually it's stock. We bought stock on credit, and now we have to pay back that stock. Creditor days are doing the exact same thing. All right, so you're calculating your creditors, you're dividing it by your cost of goods sold and multiplying by 365. A proportion that works in the same way. You're saying your cost of goods sold is the amount of money that you're spending to create all of the goods that are being produced, distributed, and sold to customers. The creditors are a portion of that, because in this case, you're buying stock. That's what the creditors are. Is you're buying stock, you're buying your goods on credit. So what proportion of that, so what proportion of the money is tied up in credits that you've gotten, the amount of your stock that you've gotten on credit versus the other portion. So in this case, this kind of tells you like what is the proportion, and then it's the same thing. So what's the proportion? Let's say it's a third of your money is in credit. Well, then a third of the year, that's also the amount of time you're going to get, more or less, that's going to be spent getting that money back. You have about a third of the year to pay that money back to your creditors. All right. So it works the same way that debtor days do, in that you're basically taking an average. The proportion of the money that the creditors are, right, the proportion of the overall spending on producing a good that creditors are, that's the proportion of days of the year, or whatever the period. If it's a month, well, then days of the month that you have to pay back, or that you're given to pay back those goods. In general, the longer, the better, because this maximizes cash flow. It means you have very little money tied up that you're going to have to spend paying back these credits. So obviously, if you can, you want it to be zero. You'd like to just pay everything up front. But in the case that it is, you'd like to have more time, which means you want the creditors to be the smallest portion of your cost of goods sold possible, is what we're saying. You want to minimize the amount of money that creditors are, all right? However, if this time is very long, is the problem, it can risk late charges. That's saying companies paying you more to pay back the credit, charging you extra interest because you're taking so long. You could have a bad relationship with suppliers if you're taking a long time to pay them back. And you could even have legal action if you bought things on credit and you're taking a really long time to pay them back. Finally, we have the gearing ratio. All right. So the gearing ratio assesses a firm's long-term liquidity position. So what they do is they examine the firm's capital employed, financed by long-term debts. So that's mortgages, debentures, things like that, which are parts of the business from external sources of funding. Okay. So, basically what this is doing is just examining, what portion of what the business's funding is coming from external sources and what percentage is internal. The formula is quite literally long-term liabilities divided by capital employed multiplied by 100. This is a percentage, all right? Percentage telling us how much, what percentage of our money is tied up in these long-term debts. This is, again, a liquidity thing because, as you know, with the debt, your liquidity goes down because you have now money tied up that is in this money that you need to pay back. A high amount of gearing is 50%. If you have 50% gearing or more, you're vulnerable to recessions, takeovers, and interest rate increases because obviously you have these debts. So if there's some kind of large economic change, it's really going to affect you because a lot of your money isn't under your control. It's having to go to pay these debts. Also, it means inadequate liquidity and dependency on long-term sources of borrowing because once you get in the cycle, if you're dependent on long-term borrowings like mortgages, then you kind of continue that cycle because you have a lot of money is generally tied up in these different long-term debts. There are a variety of factors that go into this: the size of a company, interest rates, and potential profitability that can determine if they need to get into these long-term debts or if they can maintain more of their money on their own. But anyway, those are the four main ratios. I hope that they have been more or less clear to you guys. It is, they are quite a bit to explain, but they are, I think, quite understandable at the end of the day. It just requires a little bit of brain racking. But anyway, if you have any questions, make sure to leave a comment below. Thank you for watching this video and giving you guys all the good vibes and a lot of energy to continue with your studying for the exams that they're coming up very close. All right. See ya.